This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at a full past exam paper question. So it is under the old syllabus, so you'll see it's totally different to that sample question that we did earlier on. But I think it's really useful to just help you be able to calculate the ratios and also to be able to start thinking about generating ideas as to why ratios have moved. Okay, so in the old days, I think it was a big 25-mark question, lots and lots to go through and do. But what you find is that the information is given to you within the question. You just need to apply your knowledge to the information that you're given. Okay, so what have we got? It says a friend has approached you looking for some advice. Okay, and they've been offered the position of a sales director with an entity, DFG, which supplies the building trade. Okay, now you may have not had any experience of working in the building trade, but I'm sure you've seen buildings get built before. I'm sure you've heard about how the building trade works. Okay, I'd say there with the building trade that it would be a potentially uh, volatile industry, isn't it? Particularly with respect to say economic conditions, isn't it? You know, when the economy is doing really, really well, like it was prior to 2008, then the building trade was booming, wasn't it? Okay, post 2008 and the financial crash, and when people had less money, and then the recession hit, the building trade just sort of it stopped, didn't it? Okay, so it's quite a volatile industry, isn't it? So you're being approached by a friend who's been offered a job at this business. So you want to ensure that that business is going to survive, don't we, for the long term? You don't want to turn around and go, yeah, I'd go and get a job with, who is it, DFG. Yeah, fantastic. And then a year later they come back and go, I haven't got a job anymore. Sorry. So you need to make sure that this business is sustainable, isn't it? Okay, that it's performed well in the past and hopefully going to perform well into the future. He says he commented that he had reviewed the information of DFG's website and there were lots of positive messages about the entity's future. But if you read a company's website, do you see positive messages? Yes. Do you see positive messages even if things are going badly? Yes, because they spin it, don't they, to make sure that the things look well. Okay, so there are positive messages, but it's come from the internal aspect of the business. It goes on to say there, including how it had secured a new supplier relationship. Is it there in 2010? I think we've mentioned that earlier on, haven't we? If you've got there a new supplier, hopefully what you would see there is a reduction in your costs and therefore a reduction, would it be there in your margins? But the issue that you need to think about there, isn't it, is quality. Okay. It does say that there's been a significant improvement in margins, so we would need to check that, maybe calculating gross margin, calculating operating margin, see if that's actually true. Okay. It says so our friend has been offered a lucrative remuneration package to implement a new aggressive sales strategy. Been with the current employer for 6 years and wants to ensure his future will be secure. Okay. He has provided you with finalised financial statements. So by that, I would assume that therefore they have been audited. So everything in there is correct. Okay. What have we got? What can we go through there and see? Well, be careful when you're looking year on year, 2009 to 2010. Go the right way round. So it's going from 09 to 2010. You can see that there's been an increase in revenue, can't you? But it's not much, is it? It's actually only small, isn't it? What's that? A $4 million increase in revenue. You can see there when you look at your costs and coming down to your gross profit, you can see that you've got your gross profit has gone up. But again, we'd want to go through there, wouldn't we? And maybe work out your gross profit margin. Distribution costs, admin expenses, you can see that they have gone up, haven't they? Okay, from 13 and 11 to 18 and 16 respectively. So you would be a little bit concerned there, wouldn't we? about your control. So I would want to maybe work out an operating profit margin, wouldn't I? But I don't see an operating profit figure in there, so that's going to be a little bit fun. What on earth is this about? A share of profit of associates. Where's that come from this year? It seems to be one-off and arisen in the year. Finance costs, that's a little bit of a panic, isn't it? Because they have increased. And if you go through there and look at the profit for the year, looks good, doesn't it? In that we were loss making last year and we are now profitable for this year, aren't we? But it's a small profit, isn't it? A 7, and let's face it, if we hadn't have gone through there and looked at the 7 of the share of profit of associate, then we wouldn't even have made a profit. So we're only just profitable, and one of the only reasons is because of the fact you've got the associate's profit included this year. Okay. What you can see there as well is that you have a revaluation gain on property, plant and equipment. That seems to be a one-off item, doesn't it? So maybe we've done it this year and never previously done it. If you have a revaluation gain, that's going to go through there, isn't it? And increase your equity. By doing that, it's also going to go through there, maybe. Will it reduce your gearing? Okay, so maybe that's a bit of a ratio that we can go through and potentially calculate. I'm not saying it does, but with the higher levels of equity on board, maybe that will reduce your level of debt to equity. We need to have a look and see if we have taken on board any more debt. Okay, but what you've also got as well is if you have a revaluation gain, you will have, will it be increased depreciation, which may explain the increase in distribution costs and the increase in admin costs, mightn't it? Okay. What you've also got, if we go through and scroll down, so we're going to take us a little bit of a while to do so. Non-current assets have gone up, which is what you would expect, wouldn't you? Given that the value of the assets was revalued. You've got that investment in associate, which is what we've made this year. When you look at your current assets, you can see your inventory's gone up, your receivables have gone up. Receivables and inventory have gone up quite significantly, haven't they? So maybe I think about inventory days, receivable days. Wow. Cash, ouch. We had cash last year. We have no cash this year. So that will bring about some liquidity issues, wouldn't it? You can see there within my further down in your equity section, there's been no increase in share capital. So there's been no issue of shares as finance. Retained earnings have increased by 7, which I think is the same as the profit figure, wasn't it? So it looks like there's been no dividends paid. You've got the revaluation, which came from other comprehensive income. And then you've got your non-current liabilities, which have stayed the same. So presumably our loans haven't increased, but there's been a massive increase there in current liabilities. I would be a bit curious to know what that increase in current liabilities is. Other bits of information, the loans are repayable in 2012. I know that's quite a few years ago, but the question was 2010, our year end, repayable in 2012. That's repayable in 2 years. How much is repayable? $91 million. That's a bit of an issue, isn't it? We said before, look at your cash balance. You haven't got any cash. We need to find out how we're going to pay $91 million in 2 years' time. Could be interesting. When our inventory days have gone up, our receivable days have probably gone up if you look at the figures. So there could potentially be working capital problems, liquidity problems, and we've still got a lot of money to pay back. Okay. If you look there at the contingent liability note, it's one of those that you look at and think, oh, there's a lot going on there. What do I do? Well, we'll just break it down. The notes include details of a contingent liability of 30 million. What's the accounting treatment of a contingent liability? No, we don't record it, do we? It's disclosed, isn't it? So in the back of the notes, hidden away, there is a note that says there's a potential liability of $30 million. let's hope that doesn't arise. Okay, because if it does, we'll need to pay $30 million and pay off that loan in 2 years' time. It says a major customer house builder is suing DFG, claiming that it supplied faulty goods. Well, that's quite interesting, isn't it? Didn't we have a new supplier? So maybe there are quality issues. Maybe that's why the sales haven't gone up by as much as what we expected. Here, we've been supplied faulty goods that we've then sold on, and we're being sued for it. Okay. You have to ask yourself the question, are there any other potential cases? This is just one, isn't it? Okay, a major customer. Has there been any reputational impact? Will there be any other customers who then come forward? Is the future looking good for this business? Would you tell your friend to go and work for them? Okay, maybe if you don't like your friend, you might do, but at the moment, I don't think I'd be too happy telling my friend to go and work there. Okay. If you read on, hazardous substance, the initial assessment from the lawyer is that we are likely to lose the case. So, given that these are final financial statements, we have to accept the fact that it is a contingent liability. So even though it says it's not measured with sufficient reliability at the year end, that's very rare that happens, but this is that rare situation, isn't it? Okay. So we're likely to lose it. We're going to have to go through there and pay, aren't we? We will have to pay 30 million. It might be more, it might be less, but are there any other cases? We just don't know. There could be. Okay, it's a big risk. The revaluation, we've decided on a change of accounting policy. Now, if you've got a change of accounting policy, you're thinking, why do it now? Okay, is that the best thing to do? It could be, because if you change your accounting policy and get it up to, or your non-current assets up to their most recent market value, at least that will go through there, won't it? And give you, if you like, security. So, we need to go through, don't we, and find other bits and pieces with regards to cash to pay off the loan, to pay off the faulty goods that we're being sued over. Maybe the security may help us raise additional finance. But we need to look at the level of gearing and see whether or not we are already highly geared and whether we'd be able to take on any more debt, so to speak. Because when you go through and look at the revaluation, again, it's been finalised, the financial statements. The only thing that I would be a little bit curious about is the fact that it's an employee of DFG. So that's internal, isn't there? So that brings about, maybe any ethical issues. It does say that they are qualified, so I assume the auditors would have looked into that professional qualification and verified it, but it's still an internal employee, isn't it? So maybe a bit of professional skepticism there over the level of the revaluation. Good little note there about your current liabilities. Again, payables have gone up. Well, there could be a big issue here with working capital, isn't it? We saw inventory went up, receivables have gone up, payables have gone up, cash has gone down, and not only has it gone down, oh my word, we have $39 million. Say that again, $39 million worth of short-term borrowings. So an overdraft that could be repayable on demand. Is it looking good for this business? I think we could have some cash flow issues. We could have some working capital issues. Would you be recommending the job? I don't think so. Okay. So what I've done is I've tried to pull out the key aspects from the question to get you to think about it. I'm not going to write out an answer because the answer is within the notes at the back. But if you read through the answer in your own time, you will see that the points that we have picked up are reflected within the answer at the back. Okay, so I think it's important that you go through and read the answer to understand what we've spoken through there. However, we're not just going to stop it there, because what I would like to go through and do as well is I would like to go through there and just have a play around with some of the ratios. Okay, so when we go through there and look at the ratios, again, I'm not going to go through and calculate all of them. I'm just going to go through there and choose a select few, so to speak. Gross margin should be nice and straightforward. One that might challenge you is your operating profit margin. And the reason why is because you're not given it. If you go back and have a look at your figures, and again, I'm only going to work it for the 1 year. If you go back to your profit figure, you weren't given an operating profit figure, were we? So what we go through and do is the way I would work it is I would take my 49 gross profit, deduct my 18 distribution, deduct my 16 of my admin, and divide it by my sales. Okay, so if you're curious where they've come from, the 49 is the gross profit, the 16 is the admin, and then the 18 is the distribution, isn't it? Tap that into your calculator, multiply it by 100%, and I think you come with 6.0%. Okay. So when you calculate an operating profit margin, it's your operating profits before interest and tax. Ignore the associate. That has nothing to do with your operating profits, is it? So there you have it. Okay. Other one that I'm just going to mention is your gearing. I think the way that it's been done in the answer at the back is your debt over equity. It could be debt over debt plus equity. The reason why I'm highlighting this one is that if you go through there and take your equity figure is those three figures there. Okay. 45 plus 146, is it there, plus 40. Okay. If you do that, I think that gives you, is it 231. Again, examiner making it a bit more tricky by not giving you the total equity figure, but add them together, you get 231. Okay, so that's the equity on the bottom. In terms of the debt, well, yep, you've got there your non-current liabilities, which is that long-term borrowing, which is debt. But please do just be careful. Remember, it is interest-bearing debt, isn't it? So what you've got there is you also have, is it some short-term borrowings? Those short-term borrowings there are also debt. Okay, so be careful there. So when you're working out your gearing, your debt on the top is the 91 plus the 39 divided by, is it your 231? Okay, multiply, is it by 100%? And I think that gives you, is it 56.3%. Excellent. Brilliant. Everybody happy with that bit there? Okay. Excellent. Other bits that you've got there in terms of your ratios, the answers do quick ratio, current ratio, receivable days, payable days, inventory days. Other one that you've got there is your return on capital employed. So that takes your operating profit, doesn't it? So your operating profit that you have was your gross profit of 49 less 18 less 16, wasn't it? You then divide that by your capital employed, which is your equity of 231 plus, is it there, your 91 on your debt. Okay. Technically speaking, what we should also go through and do there is we should deduct the investment in associate figure. And the reasons why there is because on the top here, you have your profit before interest and tax, don't we? Which excludes anything to do with the associates. and the equity plus debts is equal to non-current assets plus current assets less current liabilities. So what we would also need to go through and do there is to compare like for like. We would need to deduct the investment in associates. Okay, and you can tap that into your calculator and go through there and multiply is it by 100%. Okay, I think if you look at the model answer, the real CIMA answers, it didn't deduct that investment in associate, but technically you should go through and do that. Again, that's there, isn't it, for 2010. If we were to look at it for 2009, I know we're not really doing that, but we will here. Again, 25 as your gross profit, deduct 11 and 13. The equity figure that you have, if you total it up, should be 184, and the debt was 91. Technically, what you should do there as well is you should work out your net debt, isn't it? So you should go through there and remove your cash balance, okay, to go through there and get you a better figure, okay. Again, technically, if you wanted to here, and we didn't, you could add on the 39, because that 39 again is your overdraft. That's interest bearing, isn't it? So that therefore is debt. Okay, excellent. Other ones that you've got, I'm quite happy with your non-current asset turnover. Okay, so that's just taking your revenue, isn't it, and dividing it by your non-current assets. You could work out your asset turnover by taking your revenue, dividing it, is it there, by capital employed, which is essentially what you have here, isn't it? So that there is your capital employed. And here, the same at the bottom. The other one that you've got, just to go through there and finish it off, is your interest cover, isn't it? Your interest cover goes through there and takes, is it your profits before tax or profits before interest and tax? Again, here, if you start off with PBT and then you have the, is it to add on the finance cost, and then divide that there, is it by the finance cost of 12. Okay, so it's looking at all of the profits before you pay any interest. So you could, if you like, there include the share of profits of associates. Okay, so what you've got there, isn't it, is we're working backwards. That's PBT. That there are my finance costs, and then you divide it by the finance cost, and I think if you tap that on your calculator, you get, is it 1.8 times. Again, as we're profitable, we can work out an interest cover. Don't, if you end up with it with a loss-making figure before your interest, don't ever go through there and work out a negative interest cover. There is no such thing. Okay, so go through, have a work through the questions, have a work through the rest of the ratios, your margins, your liquidity ratios, your working capital ratios. See how you get on there. Make sure you have with these more complex ratios, and then if you do get stuck there, then you know where we are. Okay, please have a read through the model answer, ensure that you understand it. You should therefore as well then be able to pick up all the points that we brought forward from reading through the question before. Other than that, it's just the limitations on the ratios to go through, and then you're finished. Well done.